S&P 500 is up 57% since its March lows. How much longer is this rally likely to last? Jason Trennert, chief investment strategist at Strategas Research Partners, says he will be bullish on stocks until the bill comes due. He joins us now to explain. Good afternoon, Jason.
Good afternoon. How are you?
I'm doing okay. So what's the bill you're talking about?
Well, the bill we're talking about is the good news is we've had all this fiscal and monetary stimulus, which has taken us back from the abyss. The bad news is that we're going to have to pay for it at some point, and we're going to have to pay for it either in the form of higher long-term interest rates or higher taxes. So if we take, let's say, housing as an example, part of the reason why housing is stabilizing is because of a government subsidy for first-time home buyers, which is great if you're buying a home, but again, it's a little bit of a luxury, in my view, if you're running a deficit that's 12 to 13% of GDP. So there's, I think, a finite amount of time you have before there's a real cost to the economy and the markets themselves.
Do those things, I mean, do you see Treasury yields rising? Do you see a poorly subscribed auction? Do you see increased taxes? Does that all come in 2010? Is that guaranteed?
Well, you know, it's a good question because we have a list of 7 things that we're looking for to the bill comes due, and you mentioned 3 of them, but it essentially comes down to taxes and interest rates. Right now, if you take a look at, let's say, 30-year mortgages, they're, you know, got around a 5 handle on them, if not somewhat less. But the problem is you really don't know what long-term interest rates are because the Fed has been buying mortgage-backed securities and treasuries. So I think it's more likely to see an increase in interest rates before you see an increase in taxes, mainly because next year is an election year. But eventually, again, the size of the deficits, the magnitudes are such that it's very difficult to grow your way out of them without meaningful reform, either in the form of taxes or, you know, heaven forbid, spending. For whatever reason, no one's talking about cutting spending.
Right.
But that would be, in my view, a better way to go.
Let me just ask, does this make Paolo Pellegrini and Julian Robertson, a lot of people talking about shorting longer-dated treasuries, does this make that trade a slam dunk?
Well, I would never describe anything as a slam dunk, but I am in agreement with the trade, mainly because what's remarkable is that the average maturity of our debt has actually gone down. Average maturity of our debt is about 52 months now, back where it was in 1984 when 10-year treasuries were 13%. They're now 350. It seems to me you should be going long. The government should be issuing as much long paper as it can. It hasn't been doing that. It's been funding everything short. So it's a little bit like kind of, you know, a Bear Stearns method of funding yourself. You know, you have enormous long-term liabilities and you're funding everything short, which, you know, works until it stops working, and then it's not good.
Jason, just got 20 seconds before we have to take a break. I mean, when that bill comes due, what does it mean then for the equity play, the equity side of things?
I think we're in store for a range-bound market. I could see the market going up for the next couple of quarters, but after that, I think this is going to be a lot like a 70s style market, which you have very broad ranges in which the market trades in.
For a long time.
For a long time.
All right.